So what I want to do on this video is I want to take a few minutes to cover some concepts and some ideas with which you need to be familiar in order to really understand what's going on in the world of trading. Most of these videos are naturally me showing you recorded trades, pointing out the various price action. It went bid here, went offer, profile levels, how much size traded, are they aggressively selling, aggressively buying, etc. And that's obviously really important because that's how you gain the information. And what I've done here is I've brought up it's the E-mini S&P trade that I have up on my YouTube video. And even though I'm obviously a treasury trader mostly, I just brought this video up because it's a good example, once again, of price action. And I'll be able to kind of point some things out as I go through these topics. So kind of where I'm going with this on this video is I have some topics here that I'm going to kind of scroll through, and I don't want to lose you. I did this one time during a live webinar, and there were so many questions popping in and out that the day kind of drug on, and I think I lost a lot of people. Their eyes kind of glaze over, as I say, and they sort of stop listening. So what I've done with this video is I'm condensing it down and just kind of trying to briefly cover these topics for you because they are very important. And as you'll see as we go through them, you really have to have an understanding of the game. So that's what I'm always telling people. I'm always telling people it's about the big picture. And people are like, well, what did you see? What did you see? What did you see? Now, sometimes it is specific price action that causes the trigger for my entry or my exit. That's for sure. But for example, in this trade, there was a big picture involved. Now, it doesn't seem like a hard trade to make. I mean, which it wasn't for me, but it's an obvious big picture. But it illustrates my point, which is the big picture was the S&P had been trading down all day long. It had bounced off this level right here, and you see it clearly in the market profile. There's a step between 31,000 or between 97.50 and 97.25. From 31,000 to 7,000, and then of course the very bottom. And you have this big bid that was supporting the market several times. So when we finally get down there and they start to hit that bid, the market cracks through. Now, this is a pretty clear example of a big picture. Market's trading down, got a big bid, you're leaning on the big bid. As it gets there, I've kind of forward it through to you, forward it through to the trade here. So right there, see, is where I entered. You see, I get short. So big picture bias is obviously they're trading down. If they hit this bid, everybody's leaning on this price, and I think it'll snap through. So that's a pretty obvious setup. Most trades aren't really that obvious. You don't have this big bid that if it gives away, you'll probably be looking at an instant 2 or 3 tick winner. It takes a little bit of time sometimes to play out, or you have to get in before it happens, etc., etc. So you have to establish a bias most of the time in terms of where you think the market is going. In order to establish a bias, you have to understand the big picture. In order to understand the big picture, you have to understand the game and your competitors, your competition, your opponents, right? So that's what I want to do right here in this video. So I want to go through these topics and give you a bunch of ideas that should be floating around somewhere in your brain every day that you're trading. Whenever you're watching these videos in the webinar course, and whenever you're trading on your own, these are the things that you always need to have in the back of your mind. Okay, so except for this first one, because this is where I'm just going to give you a quick rundown on my background. But there's a reason for that. All right, so this is my topic list, and we'll scroll through this, and I'll try and get through this quickly so you're not bored, but cover what I need to cover. Just a quick word on my background. I get the question all the time, how I got started, how did I learn this? It's just a relatability thing. People want to kind of know, okay, if you had some success at this, how did you get there? So I feel that it helps to share this a little bit. I became fascinated with the markets when I was a teenager. I started reading everything I could about them, everything in the county libraries, everything at the college library where I went to college briefly, and bought some books, bought some courses, successfully lost money for about 8 years, off and on, not consistently, obviously. You'd open up I would open up an account like most people, lose $1,000 or $2, close the account, save some money again, try it again. Failed miserably, and was trying to use all the things that are predominantly sold out there with technical analysis type stuff, charts and indicators and whatnot. And so it wasn't until I landed 2 jobs. I landed a job at a stock trading firm, and they weren't funded right, and it just wasn't a very good setup. It did give me a little bit of perspective on order flow, though, just a little bit. I didn't gain as much as I did at the next firm, but I did get a little bit of perspective on it, predominantly from another guy who was there who had made a lot of money in the NASDAQ boom. He's the guy I write about in my book. That firm didn't last long. They shut down the whole department within a few months. And then I managed to find a job for a proprietary trading firm in Chicago, trading futures. They predominantly traded treasury bonds, or the 10-year notes. It was the first time I'd ever seen X-Trader. I didn't understand the importance of X-Trader until I had spent some time on it. And I was there for 7 months prior to turning the corner. And the only reason I turned the corner was because I was sitting, as I've told the story a few times, but basically I was sitting directly behind the first guy who started making real money. So there was a guy sitting across from me, but his back was to me. And I could see his screen, and I write about this guy in my book also. And he had gone from being down $20,000 or $30,000 to being up over 100, and he'd made like $100,000 in 1 month. He just turned the corner and started just printing money. So at that point, like everybody in the room realized, okay, maybe this can be done for real. Because you're always, after spending that much time trying to make money trading, you're always leery about stories that you hear, or firms, or anybody else. So this guy didn't look at anything but the X-Trader screen. Right then and there, I decided, okay, fine, that's what I'm going to do. So I turned off all my charts, everything else. I just looked at the depth of market. The very next month, I turned the corner, went positive, and then went on a pretty massive run. And I learned the game. It clicked. It literally was sort of a eureka moment. Now, you gain things as the years go by. You pick up on other types of action that you didn't see before. The markets change a little bit. Something that used to work may not work now. At the same time, you pick up another strategy that works very well, now that may not have worked before. So there's always an adaptation going on. But the game itself became crystal clear in my head, and I even remember the specific day that it became crystal clear. It's really funny. So I figured out that it was a game being played by people with billions and millions of dollars, or millions and billions would have been the way to say that. We were all just trying to piggyback whatever they were doing. Yeah, if a bunch of smaller traders go in the same direction, they will move the market a little ways, but usually you have to have some bigger money to press it to that point. And they're trying to trigger those stop orders and whatnot, and it takes a big guy to do that, or several bigger players to do that. And so once the whole volume thing made sense in my head, then it was just a matter of learning how to fine-tune entries and exits. And that's what I did, and that's what I still continue to do. Now, I left the firm due to politics, basically. It was just a bad deal overall. All of the big traders ended up leaving that firm, and the firm eventually shut down. And now I trade for myself. as do the few guys that I know that are left from there. Which brings me to my next topic, just to touch on this real quick. Proprietary trading firms. I have, most are not real firms, some are legitimate. Time, living expenses, and retail commissions are the real killer of aspiring traders. I get a lot of emails from people who are wondering about prop firms. Should they apply to one? Should they not apply to one? Which ones are legit? Which ones are not legit? Et cetera, et cetera. I don't want to get into who does what, because there's so many of them and they come and they go. My suggestion is do your research on them. But the main things that you want to see if you do apply to a proprietary firm is A, they pay you a real salary. Not to say there aren't some out there that are legitimate that don't pay a salary. It's just that if you can't afford to sit there, you're probably going to fail before you turn the corner. So if you're trying to go to work for a prop firm, they want you to come in, they want you to trade every morning, but yet you're trying to figure out how to do that and pay your rent, you're going to struggle. You're not going to trade right. And see, we were paid a salary. It wasn't much of a salary considering we were in Chicago, but it was enough of a salary to pay the bills and be poor after that. But, the bills were paid, so it enabled me to be able to go to work every day and not have to worry about paying the rent. So I could just focus on trading right, and that's a big, big part of it, which covers the living expenses aspect of it. If you don't have that, you're going to have to figure out a way to balance the two, where you can trade in the mornings, work in the evenings, and work at night. The most ideal position is that you already have the money. You have enough money to be able to sit in front of your screen for a year and not have to work, and have some trading capital. And that gives you your best odds of success. And nobody wants to hear that because, it's not a very appealing idea. But reality, or realistically, that's kind of where you need to be. But the advantage, of course, to being in a prop firm would be A, if they paid your, expenses. B, large capital. So on your own, to try to go from a 1-lot trader to, let's say, a 50-lot trader, it takes a serious run. You really have to be on your game, and you have to slowly pyramid up into that kind of level. To be able to do that at a prop firm doesn't take as long, because if you go on a run at a prop firm and the guys running it are all about, pumping you up when you're on a hot streak and cutting you back when you're not, they'll give you size a lot faster. So I definitely increased my size way faster than I probably would have been able to do on my own. And then, of course, retail commission rates, which are just huge. They're terrible. I mean, there's no other way to say it. So you have an idea. Prop traders, guys that actually work for firms, who are members of the exchanges, for example, in the treasury bonds, or in the CBOT, they pay between like 10 cents and 30, 40 cents a round turn. That's what they pay. Meanwhile, the average guy out here is paying $2.50 a round turn. So it's a huge difference. But trying to buy a seat isn't realistic for most people. Even trying to lease a seat is not realistic for most people. Depending on how much size you do. If you do end up becoming someone who trades thousands of contracts, or at least are hundreds of contracts, I should say, you're doing thousands of round turns, you should definitely lease a seat, or try and see if you can't cut a deal with somebody who can get you in their firm, and maybe you'll trade your own money, but they'll be able to they'll be your broker and give you a better commission rate, something like that. That can be done, and you should look into it because it's just huge. So those are the advantages. There's really no other advantage besides that, to be honest. People think they're going to go into prop firms and they're going to learn something. They only learn something because they had the time to sit there and figure it out. Usually, guys at prop firms, most of them aren't very good teachers. The guys who trade big usually don't want to teach. I mean, they don't have any desire to talk to you, really, most of them. I got lucky. Both places where I was, there was a guy at each place that was actually made real money that would occasionally pop over and say something to me. And I got a few little nuggets here and there, but for the most part, I've just figured it out on my own. And I figured it out because I was able to sit there long enough to do so. All right. So, and just FYI, if you're going to apply to a prop firm, I mean, you're up against thousands of applications. You're going to have to sell them somehow. You know, so there needs to be something in your background that appeals to them. In my case, it was I played poker for a living for a while as a younger guy, and the guy who interviewed me was fascinated with poker. So I managed to land the job because of that. It's sort of a lucky thing, you know. Again, opportunity meets preparation. But these days, most firms don't look for guys that do what I do, which are straight up scalpers like this. They're predominantly interested in programmers. So if you have a background in programming, you probably have a much better shot at getting in the door. Okay, so next topic. You may not trade exactly like me. That's okay. The goal is for you to understand the game and then learn how to play it. So as I go through these courses, or as I go through these videos with you, just remember, I mean, yeah, I'm showing you what works for me. I'm showing you strategies that work for me in the long run. And it's definitely stuff you need to know. And these are strategies that can work for you as well if you learn how to play them right. But, you know, we wouldn't always trade the same. I mean, I'm going to make trades that you may never want to take, and you may make trades that I never want to take, just because we all still have our own way of looking at the market. We all have our own way of managing a trade. So you may be a little more okay with risking 3 or 4 ticks more frequently than I am, you know, but you also tend to maybe ride winners better and get paid better. I don't know. The point is, don't get too caught up in just trading exactly how I trade, or get focused on one particular strategy, because that's not what you want to do. A lot of people ask me, is there one particular strategy that I need to look at and start with? And the answer is no. This is a very organic thing. You have to be able to react to what you're seeing at all times. Sometimes there's action, sometimes there's not, but you need to be able to go with the flow. So don't just pick one strategy. You know, I mean, really, honestly, the strategy is buy low, sell high. Okay, that is the one strategy to focus on. And I'm not trying to be flippant when I say that. I mean, that's what you're always trying to do. Buy low, sell high. Pocket as much as you can when you're right. Lose as little as you can when you're wrong. That's the strategy. Excuse me. So your goal then becomes to try and pick, you know, better entries and exits to maximize those profits. And you can do that. You can fine-tune those entries and exits by being more selective, and by paying attention to the price action. Next topic. Same thing. You know, I'm teaching you something you have to adapt to your own style. This is a big thing. Seeing me go over these videos with you, or going over these videos at your house, or reading my book, are a lot different than seeing it happen in real life, and that's one of the reasons why I like to run the live webinars. These videos are excellent and great primers and great instructional material, and if you can't be there live, it's fine. The videos are really good, but you know, the real-time stuff is very helpful because you sort of see what's going on as it's happening. You can ask questions kind of as it's happening. And even when I record the live sessions, I tend to leave most of the day's action in it because it gives you a feel for the overall context. Like the trades you're going to see here, I'm going to give you a little bit of a preamble, so to speak, on each trade, and then I go right into the trade and then talk about it and then cut the video. And the idea there is to sort of condense the videos down to give you the real meat and potatoes, I guess. And get you familiar with everything. But then what happens is you have to take that info and apply it in real life, and that requires you sitting in front of your screen every day for 3 or 4 hours. You know, and there are going to be a lot of dead days, or a period where the market's going to be dead for an hour and you're going to be bored out of your mind. And then all of a sudden action comes out of nowhere, you know, and if you don't jump on it when it happens, you totally miss it and there's nothing left to be had. So there's a big difference between watching videos and then trading in real life, but the videos are a requisite. You know, they're definitely a necessity to get you at least looking at the right things. This is a big one. You have to be disconnected from the money in order to trade right. I can't stress this enough. I mean, if you're concerned about the money you're going to lose, period, full stop, you don't trade stupid. You know, it's not that you're careless with the money or you're haphazard with the money. It's just that if you're worried about every time you lose 3 ticks, you're never going to make it as a trader, period. You know what I mean? So, maybe you have $5,000, that you want to put up in an account, and you think, that's fine, I have $5,000 and I'll put it in an account. And then once you start trading, you start to realize, maybe you lose $500, and all of a sudden it bugs you because maybe that's what you make a week, you know what I mean? Or $1,000, whatever, same thing. Even if you're making $1,000 a week at your normal job, you open up a trading account and all of a sudden you lose $2,000 and you think, Jesus, I just lost $2,000. I just lost 2 weeks' pay, basically. If you think like that, you're not going to make it. So you have to fund the account with money that can disappear and not affect you. At the same time, you have to be able to trade right. So what you've got to do is give yourself a large swing. So what I tell people, for example, is let's say you're a 1-lot trader, right? And you're trading a 1-lot in the 10-year. The 10-year is about $15 a tick. If you lose 10 ticks, that's $150. Say 30 ticks is $450, right? Plus commission. So say round it off to 500. So what you want to do is you want to have the margin money, and then you want to have a $500 excess on top of that, and trade your 1-lot exactly how you want to trade it until you either lose a 500 or make money. But don't lose 3 ticks and then lose another 2 ticks and then not take your next 3 trades because you're down 5 ticks. That's exactly how you lose money. A lot of people end up, and it's a psychological thing, and I discuss it actually in one of these videos that I point out where I had some losing trades and it messed with my head. Happens to everybody, but you really need to be disconnected so that if you have a downswing, you should always question, okay, did I do something wrong or what am I doing wrong? But at the same time, I mean, there are going to be times that you take a trade, it just doesn't work out. They're cracking the highs and everything about the market looks like they're going to run the high, another 4 points. So you go long and they don't. And they just, a wall, you run into a wall and they smack it against you and you have to take a 2-tick loss. I mean, it happens. It's just part of the game. So when that happens, you can't be upset, man, damn, I lost 2 ticks, and be all upset at the market. You just got to stand back, wait for your next trade, and then take it. And then you can't hesitate to take that next trade because that next trade may be a 5-tick winner. You know what I mean? And so I can't tell you how many days that I got so frustrated early because the action would be terrible, and I'd be down 3-4 ticks and just toss up my hands. And if I had simply taken the next 2 or 3 trades that I saw, I would have made all my money back plus some. And of course, that adds up over the course of a year. Excuse me. So be disconnected from the money. Poker. I like to use poker analogies when talking about trading. I know a lot of people don't play poker, but there's a few analogies that should help you a little bit. There's a book called Reminiscences of a Stock Operator. If you haven't read it, you should read it. It's a great book. It was written way back when, early part of the century, previous century, early 1900s. And what this guy talks about in that book is still pretty much what's taking place today, just in a different form. And it's kind of what you see in poker. So the analogy that I like to use, there's 2. One is that you are a very small fish swimming around in an ocean full of sharks. You're trading 1 lots, 10 lots, 20. Even if you're a 200 or 300 lot trader, you're still a small fry in these markets. Guys who trade thousands of contracts are the sharks. They're the guys that cause moves and cause momentum. So you always have to remember that you're the small stack at the table. The same way as, in poker, you don't want to sit down and play against a bunch of guys that have huge bankrolls and you can't afford to lose. You also don't want to sit down and play against guys if you don't know how to play poker, and they do. So in order for you to have any shot at the game, you need to understand at least the basics to start. You know, what hand beats what, obviously, and then you have to understand strategies. And trading is the same way. You have to understand what kind of strategies tend to work and why they work. That's the big part. It's always, why is the market doing what it's doing? The short answer is the buyers are overwhelming the sellers, or the sellers are overwhelming the buyers, or nothing's happening. So, and on the days that nothing is happening, you want to stay out. Same thing at a poker game. You know, if it's just me and one other guy, I like to say it only takes 2 guys to gamble, which is true. But when I'm sitting at a table full of 9 guys, then there's going to be more action typically, you know, and you're also going to get better odds on your money. So from a trading perspective, you know, you don't want to be sitting there trading around Christmas because there's nobody there. Everybody's on vacation. So in order for any kind of move to play out, there needs to be volume, and there needs to be a lot of volume, and that requires more players. So, you know, just kind of keep that in your mind. What is the action telling you on any particular day? Does it look like there are a lot of people who really do want to jump on board this move, or does this look like some spreaders and market makers just kind of going back and forth with each other, and nothing's really happening? And if it looks like that, the latter, you just want to stay out of the market and come back the next day. The smart money is the big money. I just mentioned that because a lot of people talk about smart money and dumb money. It's not even really that the money is smart. It's just big. So you can be a genius when it comes to economics, but if you're only capable of trading a 10 lot, you're going to lose against the guy sitting at a desk at Goldman who can trade 2,000. And he may not be the smartest guy in the world, but he doesn't need to be the smartest guy in the world because he knows he can drop size in the market here and make it crack 2 ticks and instantly cover for a profit of 50 grand. So that's kind of the difference. I'm convinced, this is kind of the note, I'm convinced there are a few major players who manipulate the markets each day. You can sometimes see orders where you're pretty sure it's only 2 guys battling it out. That does happen. I mean, there's always a few people in the mix. But there's definitely spots where it's clear that there's like 2 guys or maybe 4 or 5 guys just battling it out. And so that's why repeating patterns occur. Basically, you know, why do those things happen over and over? Because the same guys are doing the same things every day. That's why. You know, the guys who have tons of money, they know how the markets work. They know where they can push them. They know where they can't push them. They know usually when they're on the wrong side. You know, they know how to get out and exit properly. I mean, they really know. They know how to shake you out. I mean, shake people out. They know they want to buy the market up 6 ticks, but they want to get the best prices off, so they continue to sit on the offers in order to just make people finally give up and sell out, and then finally when everybody kind of gives up, then they run the market 6 ticks. So these are just strategies they use on a daily basis, and that's why, you know, you can make consistently good long-term calls, consistently good calls over the long term. It's because you're just piggybacking these guys that do it every single day. Which brings me to something I want to discuss real quick, and I'll bring this down. If you'll read some interviews, and I'm going to get to this in the topic, some interviews with Paul Rotter, the flipper, Tom Baldwin, you know, anybody who trades size, they make some points that most people don't think about very often. So I want to point this out because it's really important. If a guy, let's say, you know, a guy like the flipper, and we'll use the treasuries. Let's say the guy like the flipper maybe thinks that if the treasuries get to this point, sellers will hold it down. Okay, so there's a profile starts to dwindle here, but you know that's really an ideal place for sellers to step back in and drive it right into the profile again. So even if the market rallies through here, there may be some sellers who will pull the market back down. So let's say the market actually does get through, trades 29.5, 30, and now it's trading 30.5. Okay. The flipper thinks, all right, let's see what happens here, and he offers out 2,000 contracts. He gets taken out, and then instantly the market is printing 31s. and only, let's say, 2,200 contracts trade at 30.5. So now stay with me here, because this will help you understand what's going on. If he is 2,000 of that offer and only 2,200 trade there, that means he's pretty much the only guy offering to sell there. That's not what he wants to see. Whenever he's offering, when he's stepping up to sell 2, 3, 4,000 contracts, he wants to see some other guys also jump on board with him. So it'd be much better for him to see 2,000 trade or 2,200 trade, and then the market goes bid, and then someone else slams 3 or 4,000 into it at 30.5. See what I mean? If he sees that, he knows he has some people behind him. If no one else is interested in selling 30.5 except him, he knows he's probably on the wrong side. So what he can do is he can then turn around knowing that there's probably not a lot of size at these other prices, and he can be the guy that not only covers but also reverses and goes the other direction. So he covers his 2,000 at 31 and then buys 3,000 more, sending the market through the high. So he has access to that kind of information. When we see 2,200 trade, we don't know how much of that is one guy, how much of that is 10 guys. People who swing big size, they have that information, and it's very useful to them. And you should definitely read those interviews. There's an interview actually I have on my topics here with Tom Baldwin, and he talks about that. He goes, if he's short 900 contracts or whatever, and the market's in his face, he realizes that he's on the wrong side and no one's coming in behind him. He doesn't just cover his 900 contracts to take a loss. Why is he going to do that when he can, cover 900 and then buy 2,000 more to carry the market higher and reverse his position and try and take advantage of that move up? So that's how big players take advantage of this kind of stuff. And even here, you could see that happen possibly. I mean, you may have some guys that were long at 50 and 25, right? And they realize, man, this market is not going to hold up. And then there's this offer right here at 3,000. So that enables them actually to exit for a loss at 97 and then turn around and go short the other way at 96.75 and then try and get their money back, maybe plus some, as the market breaks through the lows. Smaller traders and newer traders don't tend to do that because they have a hard time kind of getting into that mindset of being able to fire that fast. I don't even tend to do that, but usually that's because I'm not involved at these spots. Like, I'm not usually long at an area like this. I'm looking already to go short. I'm just waiting for my trigger. But bigger players and market makers do that all the time. So that's just some FYI information for you. It's good to know that type of stuff. Here are the links to the interviews I was just talking about. So these are two Paul Rotter interviews. This is actually an interview with Borsch and Baldwin. Highly recommend reading those. Okay, here we go. Talking about the flippers' entrance into the world of trading and kind of how things aren't always as they seem. One second. I'm going to pause this video for just a minute. I only tell this story and stories like it to keep people from getting frustrated, because a lot of people, they read these stories about these huge traders and how these guys made millions of dollars, and they don't get it. They don't understand. Why aren't they able to replicate that kind of success? A lot of it is where you start. I mean, that's just the reality of it. And I tell people, if I hadn't talked my way into the job in Chicago, I would have never probably made it as a trader. I would have given up many years ago and just decided it wasn't for me. By managing to get into that firm and have that opportunity, I was able to learn the game. Paul Rotter's story is the same way. He managed to go to work for a bank, I believe it was a bank, and they put him on a desk and they just told him to trade. And trade. So he was trading on someone else's dime. He had a job that paid. And he also had a mentor, or at least he credits a mentor for helping him out, who kind of helped teach him the game. So is he a dynamite trader? Obviously he is. The guy's made millions upon millions of dollars. Not taking away from that in the least. Fantastic trader. But he had that start. And it really does make a difference. It's equivalent to, if you have to save up enough money to buy a franchise yourself, or if your uncle loans you the money to buy the franchise. You know what I mean? You get to start many years earlier if you have a relative or a friend, or even if you get a loan from a bank. Maybe some people can get loans and other people cannot get loans, and there's nothing fair about it. It's just life. This is sort of similar. If you don't have that into a bank or a firm, then you're going to have to sit here and sort of figure it out on your own. But just don't be frustrated because it seems like these guys are just geniuses that came out of nowhere. Normally that's not the case. Most of them blew up multiple times, or even if they didn't blow up, they sustained losses, and then they were able to land some job somewhere or get the funding to be able to continue on and learn what they were doing. This is probably something I don't need to tell you if you're actually watching this webinar, but I will mention it briefly. The platform that you're using is extremely important. Most people don't get it because they don't have access to the real order flow. I remember reading a forum post where a guy says trying to trade off the DOM is bollocks, it can't be done. To which I want to respond, no, you just can't do it because you probably have a terrible DOM. The thing is, you can't understand what Baldwin or Rotter or any of these guys are talking about. There was a guy back in the 90s who took advantage of the early order flow system in the stocks, the order placement system, online in stocks. It was called the SOES Bandit. And the book won't really help you now. Like, there's no real information to be had that you can apply today. But it was just kind of an interesting story about how the guy figured out how to take advantage of these things within the order book and make money from it at that time period. And that's what we're all trying to do. We're trying to figure out on any given day and any given year sort of what's working and what's not, and then hopefully make as much as you can possibly make while it's working. But just for anybody that does not have Jigsaw, obviously I'm a huge proponent of Jigsaw. I think it's just a great platform. It's cheap. It's cheaper than the other ones. You have TT. I was on XTrader for a long time. XTrader is a great platform. It just doesn't have the split prints, and that is so huge I can't even describe to you. The first time I brought up the treasuries. The treasuries are a little bit slower, and so I could follow them in XTrader fairly well. It's still better now than it was. I still spot things now in Jigsaw that I did not see in XTrader and would not have seen in XTrader. So I'm definitely taking trades that I would not have caught on XTrader. So it's definitely benefiting me from a money standpoint. But the first time I saw the ES with Jigsaw, I was just completely blown away. I was going, wow, that's just incredible. How many prints you just can't see watching on any other platform. It's just amazing. So, big proponent of Jigsaw. If you don't want it, that's cool. That's your prerogative. XTrader really is the best in my second to that, I think, in terms of order flow. Some people like CQG. It's also good. I don't think it follows the order flow as well as XTrader. Or I should say, not follows the order flow, but I don't think it's as easy to read the order flow. And then, of course, you have CTS, which is similar to CQG. Several others. But you really, in order to harness the full power of the price action, being able to read price action correctly, you really need to have a great platform, and this is the best one in my opinion right now, and it's also the least expensive one, really. When you add it all up, it's just not expensive at all. So get it. Okay, a big part of my strategy and any scalper's strategy, and also you got to understand, again, big players like Paul Rotter talk about this, and Baldwin, and any market makers, they talk about this. Market makers and huge players typically are not looking for 20-tick winners. That's not what they're doing. Paul even says in one of those interviews that I have links to, he's usually looking to the next 3 to 5 ticks out. Baldwin was kind of the same way if you read some of his interviews. Now, it's not to say they won't capture bigger moves if they happen. It's just that The whole idea behind scalping is looking for that edge. So it's like what I try to do here. The whole idea when I get into a trade is I don't ever want that trade to go against me. And sometimes that's not realistic, but that's just my mentality, and that's really every scalper's mentality. I mean, when a scalper hits into a trade, he doesn't want it to go against him. He wants to be at a spot where he has the pressure. And then the idea, of course, is what's called instant edge, which I discussed in the introductory video. But here it is. I hit 97s, right? That market never backticked to 25. Once it clears 97, I'm instantly looking at a 1 to 2 tick edge. So I'm at break even and up 1 to 2 ticks here, depending on how the volume plays out. That's what every scalper looks for. Now, bigger guys do have to move some size around, so they have to handle a little bit of back and forth. But your bigger scalpers don't generally want the market to be 4 or 5 ticks against them. They know that if it's that far against them, they've made an error in judgment in their entry. So that's what we're trying to do here. That's what I try to do every day. That's what I'm trying to teach to you. Your best bet is to go for the shorter term moves. Trying to play for longer moves, it kills people. It really does. I can't tell you how many people write me and they go, well, I messed up today. Had a 5 tick winner and let it come back to my price because I wanted 10 ticks. It's just, you can't do that. And this was a really good example also of why you couldn't do that, because this market breaks down from 97. I got out too early, admittedly. The volume threw me off, but market breaks from 97 to 95 and then rallies all the way back up to 98.50. And so day trading is not about huge winners. Day trading is about hitting a bunch of singles and doubles, and then every now and then you catch that breakout and it just flies, in your favor, and you make the home run. But that's not how you make your bread and butter day trading. You're playing for short-term moves. So I tend to be looking to make trades where same thing. I'm looking to hopefully get 3 to 5 ticks somewhere in there, maybe more if I have some pressure behind me. I take the occasional, 8, 10 tick winner or whatever. The treasuries don't usually move much more than 8 or 10 ticks before they have a pullback of some kind. The ES can sometimes be a little bit different. Occasionally though I make quick scalps. Today I did it, as a matter of fact. Today I played a price. It was kind of like this. They stopped it and I sold it and then bought it and then sold it and then bought it, and it bounced around in this area a few times. So I scalped out 2 ticks, playing 1 tick move. I don't do that normally though. And has to be a very specific action for me to do that. I'm usually trying to catch a move in hopes that it'll net me 3 to 5, 3 to 6 ticks. Okay, and that's what you want to do. You don't want to be getting into trades and hoping that they move 15 ticks in your favor. That's just no way to play it. You're gonna constantly be giving back profits. And your occasional winner isn't going to make up for all those profits you give back. So become more focused on the short term. I'm going to pause this again real quick. And kind of on the same note, I put together a video that's where I go through the reasons why you should not scale out of trades. And I know I mentioned this in the first video as well, the introductory video. Watch that video in its entirety. I'm telling you, it's just a bad idea, and you'll see why after you watch the video. So a lot of other people run into that. They end up wanting to, they're fine with being short term, but then they try and scale out because they think, I'm still going to get that 20 tick winner, and it just never happens. So a guy sells a 10 lot at 97, and then he takes off 5, at 96, and then he's hoping for that run down, and then the market comes back to break even, and he gives all of that money back on that 5 lot. You'll see why. Just watch the video. Reasons why I don't trade around FOMC or unemployment, real simple, is because you're just gambling. I mean, end of story. Don't punt. Do not bet it all on black. That's all I can tell you. If you try to trade around those numbers, specifically if you try to trade right as they're coming out. I mean, when unemployment comes out, I give it a minute or two, and yeah, when it settles back in and the volume comes back in somewhat, I'll take some shots, but I have some volume there. I kind of know what I'm looking for, and I know when I'm wrong, when I'm right. So I give it a few minutes, but when it's first coming out and it's so wild, the volume spikes are terrible. Your screens can freeze, and that's just the pipe getting clogged up on the way to you, basically. It's just a bad idea. You're going to hit into a price, and next thing you know, you're going to be looking at a 10-tick loser. And what I always tell people is there's just no reason to risk that. I mean, if you spend 2 weeks banging it out tick by tick and you're up 15, 18 ticks, and maybe it's been a little bit of a struggle, but you're still up, decent amount. And then you go into unemployment and you swing and you drop all 18 or 20 ticks in one day, being dumb like that. It's just dumb. There's no point in doing that. Why are you gonna work so hard for 2 weeks only to gamble it on a big number release? So don't do it. I don't trade FOMC at all because the action is different because it's afternoon action, and so there's already not much volume. At least with unemployment, the volume comes in right away after the number comes out. With FOMC, it doesn't even really come back in because it's towards the end of the day. So I would avoid FOMC if I were you, and not ever take a trade into a number or get involved right as it's happening. And we'll see you on unemployment day during this next webinar, so you'll probably see what I mean. We already talked about this. Just if you start doing decent amount of size, just negotiate your commissions as low as you possibly can negotiate them. Ask around. You'll be surprised how low brokers will go if they know you're doing volume. And then if it's worth your while, maybe you lease a seat or something. Scratching trades. Why do I do it? Scratching trades is usually based on I don't have a very strong opinion, and so I know I can probably get a quick edge, but then if it doesn't go, I don't want to hold the trade. So for example, even like right here, if this trade had not hung in this area and looked like it was going to come back on me, I may have scratched that trade, and that happens frequently. Even in a place like this, maybe. Let's say I'm pretty sure they're going to take out 29 halves and print 30s. So I'll buy 29 halves. I'll see them print 30s. I have a 1-tick edge, basically, but I don't have much conviction that the trade is going to go. Like, I'm basically just looking to get the bid in my favor and have them print the next price, so I have a little bit of an edge. And if it doesn't go, I just scratch the trade. It's kind of like I got a free look, basically, and there was no real volume, so nothing happened. At other times, I have a strong opinion, then I'll sit through some back and forth in my face. You'll see a few trades like that. But at the same time, maybe it looks like it is going to go. So, and you'll see a trade like this. It's the failed breakout video. I get into a trade and I think it's going to go, and it actually does pop 3 ticks in my favor. And then the sellers just sit on it and they bring it right back. So I know that if it comes back to my price, the momentum that I thought was there probably is not there, and so I don't need to be sitting in the trade anymore because I wouldn't go long then. I mean, that's kind of the whole thing. Is if you go long and the market goes up and then pulls back to that spot, if you weren't already long, would you get long again? That's a good kind of rule of thumb. And if you wouldn't, you should probably scratch the trade or take a 1-tick winner or something like that. At the same time, sometimes I'll risk that because I do want to get paid. So the market, for instance, in that trade is pressing highs, and you'll see it. So I'm 3 ticks in the money, and I don't really want to just take my 3 ticks off. I really want to see if I can't get 6 or 7 ticks out of the trade. So I'm willing to risk a tick or two as it falls back in. But worst case scenario, I would scratch the trade on those trades. So that's why I scratch. It's a totally valid strategy, especially when the market's a little bit choppy and you don't have a good feel, or when you're trying to play a breakout right as it's happening or even after it happens, and you see you're running into a bit of a wall. There are times when you can read the volume, and it's just the best thing you can do because you don't really have a strong opinion. Success typically depends on waiting for the setup. How long can you sit on your hands? There have been many times when I forced trades because I wanted participants to see action, talking about webinars here, and I usually lose on them, so that's a good example. Yeah, I don't do that anymore. I kind of let people know right off the bat, look, there are going to be some slow days and some fast days, and on the slow days, you may not see me do hardly anything at all, because that's just the reality of trading. And so if we're sitting there and there's no action, and I want to do something, inevitably I usually make bad trades. And you're going to do the same thing sitting on your own. So if you're sitting in front of your screen for an hour and absolutely nothing is happening, you can find that you try and talk yourself into taking a trade. That's not a good trade. And it just a huge part of consistency in trading is not doing that. Basically, you have to be able to stand aside and wait for your setup. Just wait, like the ball game. Wait for your pitch. Otherwise you strike out. Yeah, sometimes you're going to miss the trades, but it's going to probably save you money in the long run. Not probably, it's going to save you money if you can sit on your hands and you have more patience. Because you won't find yourself trying to get involved in those nasty range areas where there's really no good call. And you just kind of get whipsawed around. This is a big one. Always ask yourself who's going to hit the next price. At any moment when you enter into a trade, obviously the point is you're going to buy 29 halves because you think someone else is going to buy 30s. Right here, I sold 97s because I thought someone else would sell 75s. So anytime you're getting ready to enter a trade, you got to ask yourself, who's going to hit the next price? In this case, for example, I knew full well who was going to hit the next price. It would be guys would try to run this low and press the market lower. People who are short here will probably sell some more to try and to make it lower. And you'll also have people who are stuck in long trades between 25 and let's say 98 even, or maybe even higher. They're going to puke out down here. So I knew that if this market could take out this level, most likely there would be lots of sellers who would pile on board. You would have stop orders being triggered off. People taking a loss and other people trying to jump on board as it goes, like me, and people who are already short trying to short some more and force that market down. So there's a very logical reasoning behind my entry on that trade, and I have a good idea of who's going to hit the next price. If you're involved in a rangy type area, so let's say this market is trading here between 28 and 25.5, let's say. So you have this level here where it's at 78,000 and this one at 85,000. And the market's trading at 27, or 27.5 or 26.5. I mean, anybody who's long in this range, if you're long above 25.5, you're not going to bail out of your trade until the market goes below 25.5. There's no point in it because there's support there. Right? So if you're trying to play something in the middle, and you want to short 26 halves, well, who's going to hit 26? Who's going to hit 25.5? I mean, everybody's looking at the support there. You know what I mean? So don't step into an area like that where you don't have a legitimate reason to do it. I mean, if you're going to sell, at least make sure it looks like they're going to sell 25.5s and 25s before you jump on board. No one has any reason to sell these other prices unless they're going to try and take it to the low. And you're certainly not going to have any puking action. No one is going to buy 26.5, no big player, and puke at 26 or 25.5. That's never going to happen. So you lose that volume. So that's volume that's not going to help your cause. So always be thinking about that. Who would hit the next price and why would they hit it? Is this an area where stop orders can possibly be triggered off? Is this an area where people want to puke out? Is it, a spot, maybe the market has moved up and now you think, okay, yeah, if I sell this top right here and it does go off, or a few people will bail out that are already long and they'll pocket their profits and that'll help jerk the market back a tick or two in my favor. That's a valid call. Because you have a reasoning behind it. If the market's pressing through highs you don't need to just step up in front and sell it for no reason, thinking that someone's just going to come in and cap the market. I mean, you don't have any reason to think that, so don't step up and take that trade. So, you just don't. You need to have some confirmation before you do that. So, next price. Why do markets move 4 or 5 ticks through a level and then retrace back to the level very fast? This goes into what I was just talking about earlier with short-term players, but I'll explain it here so you really get the feel for it. This is a great example. What you have in these scenarios is you have a bunch of people who are long from here and a bunch of people who are short from here. They're long and short, a lot of open interest basically in between 97.25 and say maybe 1500 even. Okay? And there's a battle taking place here. What happens is eventually these sellers win the battle and they drive it through the level. So as sellers drive it through 97s, the people who are long puke out of their trades and they start selling, which drives the market down. The problem, of course, for them is that they are now selling into bids which are being placed by the people who are already short. So let's say that you're short at 98.50 and I'm long at 97.50. As the market breaks through 97.50 and goes down, I realize that I'm wrong, and I bail at I bail out of my long trade at 96 even. And who do I sell to? I sell to you. You bid to cover your short trade at 96 even. So you close out your position, I close out my position. Now the open interest has, dried up a little bit, and that's what takes place on a mass scale. It's just basically the whole way down through the level, the guys who are short from up here are all working bids and covering. And the guys who are long are selling and covering for a loss. And then eventually, once all of your guys who have puked out have covered their positions and there's no more sellers to jump on board, then new buyers come in and bid the market back up to the price. And then a few people who get hooked trying to sell the breakout, they end up buying it even higher because they realize they're on the wrong side now. They'd call it a false breakout. And then they buy it up, and then the guys who bought down here cover, and then the market settles back into an equilibrium and does nothing. And that's all that's happening. It's just guys trying to create squeezes where they can, and then they cover, and then they do it again, and then they cover. And the losers also cover, and then everybody kind of gets out. Now, yeah, you have some open interest in there. You're going to have players that are long from whatever 1490 and they're not going to sell unless it goes to 1460 or whatever, but those aren't the guys driving the market on a day-to-day basis. The guys driving the market are your bigger players and your market makers, and they're typically looking for that kind of stuff to take advantage of. How are computers affecting the markets? HFT, what's happening with his orders? How do I handle them as a discretionary trader? I described this on my site actually fairly well on the videos page. Ultimately, the way the markets used to be, you could sort of see, kind of like that trade actually is a good example. At one point in time when I first began, and then for several years after that, where I was before the HFT really kicked in, the market would have gone from 3,500 to 3,000 to 25 to 2 to 1,000. And I mean, it may have happened fast, but basically, if you were quick on the trigger, with your mouse finger, you could have watched the market disintegrate from 3,500 to 1,000 and still probably got your order off to go short. Now you have no shot at that. Now you have to basically read it prior to it happening and then get in while you can, because if you don't, the HFT beats you to it. I mean, I'll show you right here. It right there, okay? So I see the 166 print, so I know I have sellers tapping this price. I'm pretty sure it's going to go right there. I'm the 5 lot, that helps take it to 173. If I didn't do that, I missed a trade, because there's 3. Okay, so you still could have got it off right there and then there. So, 5,000 contracts, whatever, trade in a matter of a second. That's how the HFTs have really changed the game around. So you can no longer kind of lean on a price and then wait for any kind of confirmation. You basically just have to make the call, yeah, they're tapping it. I have to take a shot. If I don't take a shot now, I'm not going to get the price off. If they go, they're going to clear it out, which is exactly what happened there. That's pretty much, really, in my opinion, it does take away a bit of an edge from guys like me, but, computers lose all the time. They have made the market more choppy. They do. You'll see them pile on board, and that's why you'll see like a market, a bid will stack up to 3,000, for example, and there'll only be 400 on the offer, and no one will buy the 400. So that's just a bunch of computer orders piling on board. They do that. They buy it, and then they bid it in an effort to get someone to hit the next price. But they're not actually interested in hitting the next price themselves. So you do see more spoofing like that, more bids and offers piling up and going back and forth. But ultimately, this is the core, what's actually trading, and your profile. What is actually trading? Not your spoofs, not your bids and offers pumping up, but what's really exchanging hands. That kind of tells you. So if a guy really does want to sell 3,000 there, well, you see it. There it is. So, guys sold 3,000 there. Well, that's some good selling pressure. That's exactly what I want to see if I'm short. If I see a offer of 2,000 and then I only see 500 trade there, and then a few hundred trade at 975, and then a few hundred trade at 97 again, that's not what I want to see. Because that means you don't have the trigger orders being set off, which are helping to push the market down. So I want to see active selling. The sellers need to actively be hitting the bids. And with regards to the HFT, they do that. And they're actually a benefit in that way because, excuse me, the HFTs are what caused that. They have these, they're stop automatic orders that are triggered within these programs. And so you will often get some very nice sweeps, which are a complete result of HFT programming. And if you're already in, which is why I've emphasized before she goes types trades or as she goes types trades, which is what this one is, if you're already in the trade, you get to be the beneficiary of those programs setting off all those stop orders and driving the market, 2 or 3 ticks in your favor almost instantly at times, sometimes even more. And the E-minis, you'll see it occasionally in a run 7, 8 ticks just straight up. And that's all programs taking place. So I don't really find them to be that much of a hindrance, to be honest. I have had to adapt to not being able to lean on prices, but it's not like a lot of people would tell you they rule the market now and you can't beat them, blah, blah, blah. And it's not true. You just have to know how to trade around them. Big lesson. If you lose 50% of your capital, you have to make 100% to break even. I learned that before I even began trading for real. When I was younger, I learned that. One moment. Let me pause this. And the reason I learned it is I learned it from, some book a long time ago. And I remember when everybody's 401k was, going to the moon on the NASDAQ boom. And as it started to fall back in, I told a couple people that I knew, I said, the market's probably, if you've already given back that much, you should probably take it off. And like, oh, well, what if it comes back? I said, well, you have to remember, it's a lot harder for a fund to make 100% than it is to lose 50%. And that's just the nature of markets. For whatever reason, sell-offs happen a lot faster than bull runs typically, for the most part. So just keep that in mind. It's a lot harder to double your account size than it is to give half of it away if you trade like an idiot. So, whatever, lesson. Don't try to trade one market based on what another market is doing. Avoid the trap of looking for correlations. Now, correlations have their time and place. There's no doubt about that. But you really need to know what you're looking for, and you need to know that it's working right now. An example of that, a lot of people ask me, they say, well, if you're trading treasuries, why don't you keep the S&Ps up? Sometimes I do. Sometimes I will have the S&P up, or I'll be bouncing back and forth between the two, kind of paying attention to what it's doing, but it's not a reliable indicator even 50% of the time. I mean, there's plenty of times the S&P will tank, and this was a good example, actually. The S&P went down and the bonds didn't go anywhere because it was late in the day for the bonds. But even in the morning, there'll be times when the bonds, they'll be having their own thing going on, and the S&P won't really be doing anything. And vice versa. So there are some days when there's a bit of a correlation, but you still need to be, like, for example, if you're working on trading treasuries, still make your entries based on what you're seeing in the treasuries and your exits. But watch the volume. It's okay if maybe you think the treasuries are going to go up anyway, and it also looks like the S&Ps may go down, and so you get long, and then you kind of hold on to that and see what's happening. And then you see the S&P start to crack, and now you hold that trade. You're like, okay, yeah, this could go in my favor if they start to buy it. But if they don't buy the treasuries at all, you may want to rethink that trade. And you still, even if it goes up, you still want to be looking for signs of the volume within the treasuries that they're slowing down, because sometimes the S&P may break down 10 ticks, and the treasuries rally 3 or 4 ticks, and then actually the treasuries stop rallying before the S&P goes back up. So the treasuries will go up 4 ticks and then drop away 2 ticks before the S&P turns around and starts going back up. And so you end up giving away a few ticks of profit if you're not watching the treasury volume. And some people try and watch the ES with oil or gold or whatever, and I don't really recommend that. I will say if you're a Eurex trader and you trade the Euro stocks, you should watch the DAX, at least right now. I've noticed, I've done quite a few overnight sessions, and the DAX is a pretty good indicator of where the stocks is going to go. Specifically from an exit standpoint too. Sometimes they're both a little tricky from the entry, but you can often get into a stocks trade, and if you're right, the DAX will run, and then the stocks will eventually follow it, and then your DAX will show signs of turning around, but you can still get your stocks trade off at a good exit price. So, but in general, you should not be looking to do that with other markets. I just wanted to point this out as kind of a finish up. There was a guy who took my course a while back and went through the whole webinar process, and seemed to be, committed to it and whatnot. And he wrote me and he said, I've been trading for 2 months. I'm down $750. I just can't seem to make any money. My win-loss percentage is terrible. I'm out, but I appreciate the information in the course. It's not that you didn't teach me anything. I learned a lot. Obviously this is not for me. And I say, I told him, what, if that's the way you feel, you're doing the best possible thing by closing your account out now. And I tell people that all the time, and I'm not kind of like stressing that to you who may be watching this now. You may be ready to go gung-ho, and you may be the next $1 million trader. It's just that I like to share that because I know a lot of people think they want to do this, and then they get into it, and it's not what they think it is. And if that's the case, if that ever becomes the case for you, you should quit while you're ahead. And being ahead can be being down a small amount of money, because there are plenty of guys who kind of, they may have known after they lost $750 or $2,000 or $3,000 that this was not for them, but yet they didn't want to lose that $3,000. They wanted to try and break even and then close their account, and they lost another $5,000 on top of it. This isn't easy. It's a constant battle. It's a constant struggle. Sometimes there are what I call free money trades. It's almost guaranteed, but those are rare. Usually there's some struggle back and forth, and you're gonna have winners. You're gonna have losers. It's a long-term type game, and you have to be in it for the long haul. And I always tell people that, I can help you shave tons of time off of your learning curve. But you're still going to have to sit there for the next 6, 7, 8 months before this thing is going to start to really sink in. But it can sink in, and the testament to that are all the people you see on my testimonials page, and others that you don't see, and have never and will never talk to. But I get people that they contact me, and they contact me a year or a year and a half after working with me, and they go, I see what you mean now. They started to see it within 4, 5, 6 months, but they didn't really see it. And they realized that between that time period of 8, 9 months and maybe 14, 15 months, they learned so much more. Like, it just started to really, really sink into the brain. So as you go through these videos, I mean, it's going to make sense to you. You'll see, oh, okay, I get it. There's size there. It's like on this trade. There was a massive bid there. The bid got cleared out. It instantly went down. You had orders being triggered, and the market continued to trade on down from there. As the sellers sold enough to push it down, sit on it, hit the next price, sit on it, hit the next price, sit on it. So that aspect of it will make sense to you for sure. But there's going to be some setups that may not be as clear. There's going to be times when you're not really sure how to manage a trade. This was a good one for me, actually. I mean, I didn't manage it the best. I'm sitting here 3 ticks in the money, but there's so much size traded there that they kind of threw me off. I thought, well, maybe it's only going to get through by 3 ticks and then reverse back to 97.50 again. I really didn't know, so that's just part of the game. But you do learn to get better, and there'll be times when you manage your trades better, and it's a lot easier. There'll be other times that you can make that same trade and they'll just crush it, and you'll be looking at 7, 8 tick winner, and then you can just kind of ride it out from there. The point is, it does take some time to get the feel for this, so you really need to be in it for the long run. You can't give up after 4 or 5 weeks, if you want to make a shot at this. I mean, if you're having a hard time and you're worried about the money, trade a 1 lot. Stick with the 1 lot, and stick with the 1 lot for 6, 7 months, if that's what it takes, if you can do that. Until you get it. Yeah. And if at any time you can tell that this is not for you, then yeah, you should go ahead and cut your loss. But I try to stress that, you can't really give up in the first year if you have aspirations of being a professional trader and making a living doing this. You just can't give up in that first year, because it'll be really, really frustrating. But you'll make so much progress. Usually, I mean, I still do stupid stuff. You'll see it on these recordings, and you'll see it in the webinar, the live sessions. I'm sure. I do stupid stuff all the time. But overall, I come out ahead. I did an advanced webinar in February, and it was pretty good. I finished up 23 ticks per contract. And I had losers, and I did some stupid stuff in there, and I still came out ahead because it balances out over the long run. So where I'm going with that is, in the long run, it takes some time to get there, But once you get there, your results will most likely improve. I can't guarantee it, because I can't guarantee anything in this business. But once you begin to get the hang of the volume and whatnot, it should improve substantially. Just have the patience to get to that point. It's like any other business. You don't become a doctor or a lawyer overnight. You don't become an engineer overnight. This is even worse, because you can't really, this isn't like a skill set that can be taught in the tangible realm, if you know what I mean. It's if you open up a coffee shop, and people gotta come in to buy coffee, and it's that simple. And you sell them coffee, and if nobody's in there, you don't sell any coffee. This is, 24/7 action. There's all these numbers blinking everywhere. There's always a game being played. So it's a bit more of a mind poker-like skill set that you have to have. And even then, there's an element of luck to it. But that luck balances out over the course of the long run. So, okay, so I hope this video didn't bore you too much. I mean, it's just really important stuff, and you need to kind of keep all these ideas in the back of your head at all times. And it should, the information that I just shared with you should help you sort of understand the upcoming videos where I cover the trade recordings and whatnot. And be sure to check out that scaling out trade. And then I have a video where I tell 2 kind of war stories, and there's a point to both of the war stories, so that's worth watching. It's only like 20 minutes long. Okay, so on to the next video and recorded trades.